Kitco News special coverage of the 31st Global Metals and Mining Conference is brought to you by Gold Terra.
Hello and welcome to Kitco News with me, Paul Harris. We're at the BMO Metals and Mining Conference here in Florida, and this morning I'm joined by BMO Commodities analyst Colin Hamilton. Good morning, Colin.
Good morning to you.
Now, we've got a lot to talk about today in both the copper and the gold space, but let's start with gold. There's a lot of things going on that potentially influence the gold price at the moment. We're in an inflationary environment as one, and obviously there's geopolitical conflict, Russia and Ukraine. What do you see as being the main sort of drivers behind the gold price at the moment?
At the moment, we both have the macro factors and the micro factors going in gold's favour. We have very strong emerging market demand. We've had record Indian gold imports over the past 6 months. But macro asset allocators in the world we're in at the moment are rotating back into gold a little bit. So we saw those ETF outflows last year. They've stopped. We've got central banks buying. So at the moment, even with rate hikes coming through and monetary policy still tightening, net tightening across the world, gold is pretty well supported from a demand point of view. And that's helpful. And we're seeing, of course, that reflected in the price we're at today.
Okay, when the Ukraine conflict and the Russian invasion started a week ago, we saw the gold price initially spike. It was up sort of $50 to $70 on the day, and then it closed that day actually down. Why is that? Did the market sort of discount the long-term impact of that?
I think there's a little bit. I mean, we've seen some very volatile market flows, and we've seen risk on and risk off, and even within a given day. So I do think that there was gold can always be used as a funding source if people do a risk on rally. And I think we saw a little bit of that. Now, with the invasion persisting, we're still seeing safe haven demand coming through. And I think that will be an ongoing theme over the next month or so.
Okay, well, the gold price has, since the invasion, has continued trending upward, and it's over $1,900 per ounce, and it's about $1,920 this morning. And people, because of the sanctions going onto Russia, people are starting to talk about the sort of potential for global trade interruption. Is that having a positive impact on the precious metals?
It's a very positive. Well, for all commodity markets at the moment, it's an inflationary influence. We are disrupting trade flows. Funding material around the world is hard. And what we're likely to see is more material head towards China, but not at today's pricing. So there's a lot of different dynamics going on there. The one thing I would say is, as we look a little bit further out, I mean, number one, this is not great for sentiment in the global economy. But secondly, it will hurt demand. Inflation always hurts demand in the end. Now, for gold, that's not so bad. In the early stages of inflation, you are still going to see that rotation in. But when we look at some of the industrial metals into the second half of the year, we may see a little bit more pressure.
Are we going to see more sovereign buying as well? Russia's central bank started buying gold again. I believe it's about the fifth largest national holder of gold, and they're starting to buy again. Is that likely to drive up demand as well for the yellow metal? We saw
sovereign demand pretty strong at the tail end of last year, persisting into this year. What Russia's central bank does, we'll have to wait and see. Given the liquidity crisis they have in that economy at the moment on the back of sanctions. In terms of other central banks, perhaps I would actually expect to see a little bit more buying of things like grain actually at the current time, because with an inflationary environment, they need to make sure they're feeding the population, particularly in emerging markets. So I see sovereign bank buying as kind of net neutral at the present.
Okay, well, the gold price has been sort of relatively healthy and relatively historically high levels for the past year or so, and yet the gold equities haven't really responded. They've been sort of lagging. Why do you think that is, and what conditions will it take for the gold equities to sort of catch up with the gold price?
Yeah, so the gold equities have always struggled a little bit to get generalist interest coming through. They don't play as well into the energy transition theme that we're seeing pervading metals and mining markets on the whole. I would say the capital discipline they're showing is helping. We're starting to see shareholder returns coming through, but even compared to other sectors, they're not that strong. Now, I think part of the challenge is there's a lot of, if you want split liquidity, there's a lot of gold companies out there. And it's easier for investors, particularly given the market cap spectrums we look at now, to look at the larger equities on their own. And it's still a little bit harder for some of these small to medium cap gold equities just to get the time in front of investors.
Okay, well, we're at obviously the BMO Metals and Mining event, which is one of, arguably the best mining event in the world.
It is the best mining event, yes.
And for many people, it's the first event they've been to for a couple of years. Is the fact that investors haven't been able to sit down across from mining companies for, in person for 2 years. Has that had an impact on the willingness of investors to invest in the mining sector?
I think so, and particularly when you look at a sector like mining, particularly at the early stage, it can be very technical. And getting technical information across on a video call is naturally hard. And you do have a situation where just engaging and getting that one-to-one interaction. So it's fantastic to be here and to have an in-person event again. Everyone who is here wants to be here and is determined to make this a great conference. And I do think just if we look at it, really filled meeting schedules for all these companies. They're seeing investors again. Investors are starting to, feel the energy coming through, and I think that will help on the whole.
Well, I definitely feel the energy coming through. Now, a lot of the gold producers are talking about how their equity is undervalued compared to the market in a historical context. And yet producers are sort of cash rich. They've got very strong balance sheets. They've paid down debt. They've got, high liquidity. Are we entering into a market that's very ripe for M&A activity and an M&A frenzy?
I think certainly there's opportunities here. As you say, balance sheets are now extremely strong. The industry as a whole is ex-growth. And there's two ways to do growth. You either do it organically or you do it inorganically. And at the stage we're at the moment, it feels like that inorganic growth could be a better way to go. We started to see it in the gold industry a couple of years ago, obviously the higher level mergers, and then that spilled down to the mid caps. And then it didn't really follow through in the same extent. I think there's still opportunities there for synergies, particularly in many local jurisdictions and hubs, and the hub and spoke approach to really get value through. So I do expect to see more activity in the coming months.
What sort of size company, where do you expect to see the action? In the sort of the big companies or the mid-tiers or even some of the smaller single asset companies?
I think it will be, we have seen a lot of action in the small single asset companies. They had lagged in terms of valuation, and we're now starting to see them hoovered up to a certain extent. So I do think mid caps, if they get to that point where they're a million ounces, they want to go higher. They want to get more, time in front of investors. I think that's the area we might see more.
Okay. Yesterday here I interviewed Clive Johnson of B2 Gold, and he talked about his frustration or his company's frustration. And they make approaches to other companies, and the other companies don't tell their boards, don't tell their shareholders that's potentially an offer on the table. And he was talking about potentially having to go hostile and appealing directly to shareholders about potential value creation in deals. What are you seeing? You do see there are managements that are entrenched and not being completely transparent with their shareholders?
It's always hard to know that. I'm obviously not on that side of it. I don't know what they're hearing. I would say, what you get in the mining industry is people who are passionate about their projects and what they do. And naturally, there's always going to be an element of emotion tied to that. And convincing someone that maybe someone else should take over that project is always going to be hard. I don't think this is a new thing. I think it's always been the case in the metals and mining industry. But as we head towards a cycle where maybe we do see opportunities to consolidate assets, it will be interesting to see. How we haven't seen too many hostiles so far, and I don't know whether we'll see any more. I do think the friendly approach is always the best if that can be made to work, and then we'll see.
Okay, thank you, Colin. Let's talk a little bit about copper now. The red metals had a strong couple of years, $4.50 a pound. A lot of companies previously spoke that their incentive price to bring on new production was about $3.50 a pound. We've been well above that for, as I say, a year or two now. And yet you're not really seeing projects being put into production or development starting. We're certainly not seeing a great deal of M&A in the copper space, even though most people see there's a copper deficit coming. What's it going to take to really get some sort of M&A or project development going in the copper space?
So I think Paul, the project development thing is very interesting. We've never seen a cycle like this before, where the metals and mining industry has made so much money for such a sustained period and not pushed projects hard. Now, I think this is a number of reasons for it. Number one, the length of time it takes. Number two, the permitting. And number three, if we look at some of the typical jurisdictions, Chile or Peru, well, they've been going through governmental changes, which makes it hard for a board. If you're sitting on a board, the economics you're not so sure of, the costs are going up, and you don't want to be pushing a project forward and suddenly the costs go out. We're in that type of inflationary environment. And bear in mind, shareholders are rewarding you for giving them cash back at the moment rather than spending it on new projects. Now, copper is one, as you say. The long-term dynamics look great. And it's going to be very hard to balance the books. Actually, the way I see it, we probably won't get enough project investment, and we'll end up having to substitute through the cycle in order to bring that market to balance.
Okay, while there perhaps hasn't been a great deal of activity at the copper producer, the large diversified stage, there's been some really good action in the junior copper explorers. A number of companies have had good drill hits, which has propelled their share highs very high. Solaris Resources is one, Filo Mining is another. And just this week, yesterday, BHP announced $100 million in Filo Mining. So that seems to be a very sort of buoyant space right now, the junior explorers for copper.
We will need more copper supply, and it's a commodity that has been perhaps underexplored over the past 20, 25 years. Now we're seeing people maybe making a bit more effort, and of course things like exploration has moved on quite a lot in the past 10 years. New techniques coming through and using a lot more data to try and find these resources. So we're at a stage where people want copper growth, and it's hard to come by. It's expensive to come by to go and buy. So typically this is going back to the way the mining industry always used to work. The juniors explored, found assets, and then the larger producers took some optionality in that. I think we're just moving back to that historical trend.
Okay, thank you. It's also interesting what you mentioned about the jurisdictions. Peru and Chile, the number one and number two producer in the world there. There's some political turmoil there at the moment, and it seems that that's giving an opportunity for other jurisdictions, notably San Juan in Argentina, British Columbia in Canada's coming back on strongly, and also the potential in Ecuador. How do you see the copper landscape changing from that point of view? Is this really the moment for BC and San Juan to shine?
I think wherever people can get copper from, they will be looking towards it. I mean, even if we look at the DRC and you look at the success that Ivanhoe have had in delivering that asset on time, on budget. So we're going to see a lot of different areas push forward. Chile hasn't really grown in 20 years now. Peru grew very well 4 or 5 years ago and has actually stalled in terms of output levels. So people are looking outside of these for new projects. The challenge is always going to be the time to get these to market, because we know the copper deficit's coming. Can we get enough projects through quickly enough? That will be hard.
And to add to that, I think the US is also in that camp, because whilst President Biden talks about the importance of critical minerals, the importance of having domestic supply, copper projects in the US are having a hard time. The various different US government agencies keep knocking them back, keep delaying them, keep saying no, basically.
Yep, and that is, in developed markets in particular, permitting is going to be hard. Permitting new operations has always been a challenge, but the number of boxes that have to be completed is going up all the time, and the time to deliver these goes up. Quite frankly, if you're on a board, it's hard to do now. It just takes that so much longer. So it's interesting, where do we get the supply from? We'll end up in copper having to get a lot more scrap coming through. Scrap and secondary material will probably actually be the supply growth. I wouldn't be surprised to see the metals and mining industry invest more in recycling, because there's actually some skill sets that are very transferable across them.
Okay, crystal ball time, Colin. 2022, what's going to happen this year in the gold and copper space? Where will we end the year?
Yes, it depends when inflation causes problems. I mean, inflation cycles, say, good for commodity prices in the early stages, but at some point you do hurt demand. I would say gold price expectations are generally being pushed a bit higher than they would have been before. But what I would highlight is we're very, very good commodity prices at the present time. As you said, well above historical norms for a sustained period. Given where we are, and given that inflation does end to hit the consumer, we would be expecting the copper price a bit lower by year end. Gold a little bit lower than we have today.
Okay, and some corporate activity this year?
There's always going to be corporate activity, but I think I say the strong balance sheets, and we are starting to see at this conference, I'd say, a little bit more of a pivot back towards thinking about growth again, rather than just purely shareholder return. Now shareholders still want cash. But I do think there's a little bit of pivot towards looking for growth, whether organic or inorganic.
Excellent. Well, thank you for sharing your insights with us today, Colin. Colin Hamilton, commodities analyst at BMO.
Thank you.
Kitco News special coverage of the 31st Global Metals and Mining Conference is brought to you by Gold Terra.